Greetings to everyone. Hope you're all fine. Yeah, please. Right, so today we'll be talking about corporate restructuring and reorganization and corporate reporting. Kindly give me a like and also subscribe to the channel if you are coming here for the first time. And also remember me in your prayers, okay? Because I'm malarial want to destroy my life. That's why I've been inactive for a while. All right, so when we say corporate restructuring and reorganization, it happens in a whole lot of situations, not only when we talk about restructuring and reorganization, it happens in almost every part of our life, not only in the corporate aspect. So sometimes it gets to some time where you feel like the friends you are even having are not able to help you. So you want to make some new kind of friends. So notwithstanding to remember just recently, Barcelona got rid of Messi and some other players just because they were restructuring their team due to financial kind of problem, right? So Messi left and some other players also left because of restructuring, right? So this session is going to cover how we are going to account for it and also why sometimes there is a need for it. So at the end of this session also, I'll solve an example where I think that will be a tutorial on that and then we move on. All right, so corporate restructuring and reorganization involves any substantial change in a company's financial structure or ownership, business portfolio, designed to increase the value of the firm. So they do this to increase the value of the firm, right? And in doing this, we have basically like two. So it's either we are restructuring or reorganizing or we are liquidating. So when it comes to restructuring, reorganizing, what we are doing is that we want to reduce the capitals that are available. In a situation like Barcelona, they wanted to reduce the salaries and the expenses. So they let go of players that were taking higher pays and the likes, and then they brought in people from free agents and academy, right? Yeah. But in the case of liquidation, they want to just sell the company out and then distribute the money that they get to those they are owing, right? So the creditors and the likes. Okay, so reorganization can also refer to the sale or measure of a company that involves a change in ownership, legal and management level changes, as well as changes in stock. So I don't really need to talk more about it. So we have the types of restructuring can be um, financial restructuring and operational restructuring. Financial restructuring basically means that they are trying to reduce the available capital, right? The shares that are available, they want to reduce those values and also maybe inject more capital into the firm. And the operational one is when they dispose of some sessions of the company that is not profitable. All right, so financial attempts and aim at improving the capital structure of the firm, adding debt to reduce a corporation's overall cost of capital, debt resettling, equity for debt swaps, and the like. So if the firm is in bankruptcy, financial restructuring is laid out in the plan of reorganization. So under restructuring and reorganization, a company does not just wake up and then be like, no, I'm restructuring and reorganizing. No, you have to seek a court approval and also do some kind of scheme. So you have to create a scheme and then show the scheme to either the board and then the creditors and then see whether it favors them. So when it favors them, that's when they are going to accept the scheme. But if it doesn't, they are going to oppose the scheme. So we have operational restructuring, process of increasing the economic viability of the underlying business model include measures, disposal of divisions or abandonment of product line, closing down unprofitable divisions or units. So in most turnarounds and bankruptcy situations, both financial and operational restructuring occurs simultaneously. So capital restructuring scheme, what is it? So the restructuring scheme is a scheme where a company reorganizes its capital structure after persistent loss and have resulted into accumulated deficit. So the scheme is brought up when the company is on its knees, like now there's nothing to go on for the company. So they will bring up the scheme that they want to restructure the organization. where maybe they have to issue more shares or they have to convert some debt into equity and the likes. So reconstruction scheme might be agreed upon when a company is in danger, but when it's in danger, being put into liquidation, but holds up good promise of future. So instead of they liquidating, like instead of they selling up the company, they bring out the restructuring scheme to show that yes, still now they can be making profit, but it's just this short-term kind of situation that is bringing them up. So prerequisites of an acceptance of scheme. So what will make a scheme be acceptable? So there must be there must be a real need of it. So if there is no need for the scheme, then it will not be accepted. So it should be last scheme to adopt, without which the business would go into liquidation. It should treat all stakeholders of the business fairly and equitably. The preference shareholders must not be treated with proportionate favor in comparison with equity shareholders. So it should offer shareholders a better deal than if the company went into liquidation. So if the scheme does not offer better deal than they go into liquidation, then it might not be accepted. So what this basically means is that if you are selling up the company and me, the debtor, I'm going to get 30, and when you are going to continue operation or you are going to bring up this scheme and I'll be getting 20, then I will opt in that you sell the company because 30 is higher than 20. So if it did not, the creditors would press for a winding up of the company. It should be included. It should include an arrangement to pay off the company's existing onerous debts or converting them into the forms of liability to secure some financial relief to the reconstructed company. They should also hold out a promise of future profit. That is, there should be a turnaround. So types, we have the capital reduction and restructuring, capital reduction and capital reorganization, where they are almost the same, and liquidation. Liquidation is basically selling. So capital reduction is they reducing the already existing capitals, and also capital reorganization, they bringing in or converting some loans or debt into equity and the like. So capital reduction, and then the liquidation is basically they selling up the company or the assets of the company. So capital reduction scheme and capital reorganization scheme are related and are usually implemented simultaneously. Sometimes the terms are used interchangeably. So this is a scheme. This scheme addresses the issue of negative retained earnings, negative retained identified above. Capital reduction scheme essentially recognize the loss that the equity and the equity holders have incurred by adjusting equity reserve account. The company eliminates any negative retained earnings. So whenever you are trying to bring up a scheme, any negative retained earnings must be eliminated. And any unpaid share are written off by reducing the value of each share capital and restating as fully paid shares. Any unpaid capital not backed by available assets are written off. Example, reducing intangible and then share capital. So reorganization also does the same. So capital reconstruction scheme addresses the issue of overdue interest, writing off overdue debts and restructuring debts to have lower interest and then extend the maturity. Writing off cumulative preference shares dividend owed, and then also writing off amounts owed to suppliers. It's also aimed at issuing new shares, which is crediting equity reserves to previous debt holders. So some of the questions very soon, and we will understand all this very well. Preference shares holders, suppliers for accepting to restructure the debt. So for liquidation, it's straightforward. They sell the assets to another company. Then they try and then pay their debt in order of some kind of in a particular order. So they pay the secured debts and then they pay the unsecured debts. And they won't be like, oh, we are paying all unsecured debts and then no. So you will see it very soon. So using the proceeds to pay the debt remaining and liquidating the business. Profit recognized is based on proceeds less carrying amount of remaining net assets. So we just sell the carrying amount of the remaining assets that is in the business. The buyer of the assets will still recognize goodwill of on their fair value of the assets, but we there we won't sell any goodwill. So resolutions, reducing capital shares. So subject to confirmation. So that's why I said that the court is going to confirm that you have to do this kind of reduction or restructuring. Company limited by so reduce its stated capital in any way, extinguish or reduce the unpaid liability on any of its shares, resolve to pay or return to its shareholders any of its assets which are in excess of the wants of the company, to alter the regulations by cancelling any of its shares. So where a company has passed resolution requiring a confirmation, it may apply to the court for an order confirming the same. Where the resolution acquiring confirmation involves either diminution of liability in respect of shares with an unpaid liability or payments or return to any shareholders, and in any other case, if the court so directs, the following provisions shall have effect unless having regard to the special circumstances of the case, the court shall otherwise direct. That is to say, every creditor shall be entitled to oppose the scheme. So whenever you make a scheme, any creditor that the scheme is not favoring can oppose it and be like, no, I don't like this scheme. The court shall settle a list of creditors so entitled to oppose. The court may refer the application to the registrar, who shall appoint one or more competent persons to investigate the fairness of the resolution for reduction and to report thereon to the court. The remuneration of the investigators shall be fixed by the registrar, and the expenses of the investigation shall be borne by the company. So any of these expenses, scheme expenses and whatsoever, will be borne by the company. You that you are not having money, so you want to close down or restructure, no, you are going to pay all these expenses. So that's why you say that restructuring is actually difficult. In the case of even you making new friends, right? It is so costly because you're now going to find new friends and then talk to them and those kind of stuff. Make sure you show them fake love. And for example, Barcelona, for example, after restructuring, look at how they were struggling on their league table, right? So it is actually expensive. It is actually expensive. So the court is satisfied that creditors who are entitled to oppose the scheme have been paid their claim or assented to the scheme, that the provisions of section 75 and 76 of the code have been complied with, and that the resolution requiring confirmation is fair and equitable. May take an order confirming the resolution on such terms and conditions as it thinks fit. So before I move on, for example, this capital reduction and restructuring is the most, I think we can say that's the most easiest this semester that you can score all. So don't joke with this. I think the registrar upon protection of creditors, if the company fails to pay any creditor the amount owed him, every member of the company shall be liable to contribute for the payment of the debt, an amount not exceeding the amount which he would have been liable to contribute on winding up of the company. So now we come to some accounts that we'll be needing for restructuring, right? So you will need the assets, we need liability, we need stated capital, we need capital reduction too, right? So basically, capital reduction is the big account that we are going to use for restructuring. So what this will look like, now we will just go back to our holding days of our T account. So capital reduction will be here. Capital reduction, right? So any revenue we are going to get during restructuring will be here. So any revenue will be here, and then any expenses will come here. So for example, if you are if some group of people are owing you, and then there is some part of it that is bad, right? It's an expense and it will be debited to this account, right? And also if you are owing someone and then the person tries to give you some, like be like, oh, don't pay, or I've dashed you some, it will be a revenue difference. The amount that the person is saying don't pay is a revenue. So it will be what at the credit side. So any revenue will be credited to this capital reduction account, and any expenses will be debited to this capital reduction account. And also, after closing the account, right? After getting everything, you actually close the account because the capital reduction account needs to be cleared up, right? So any because of restructuring, you are likely to get a debit side, which is the expenses to be more than the revenue. So the difference will be here. So the difference will go to your stated capital, and then you send that difference to your stated capital, or to reduce your stated capital by it. And we will solve a question very soon where you will get it to go. All right. So we will solve it, and then this is basically it, but we'll solve it like it. All right, so this is how the scheme is being designed, the procedure. So we have to first determine the amount of capital reduction required. And then this is depending on the intangible assets written on. So that's when we are going to create the capital reduction account. So intangible assets written off, we are going to write off all intangibles, like for example, goodwill and the like. Then assets also will be written down. Tangible assets, upwards revaluation will also be recorded, and income surplus deficits will be written off, and preference share dividend in arrears also, and then the cost of reconstruction will also be there. So we are also going to determine what each stakeholder will receive if the company were to be liquidated. Based on the results, we determine the appropriate acceptable sacrifice that each stakeholder will have to bear, giving reasons in each case. Then we have to draw up the resultant statement of financial position if there is anything, like if in case we are maybe restructuring, right? When we restructure everything, we have to draw the statement of financial position and look at our state, what it will look like. Then we have to also evaluate the scheme from the point of view of each stakeholder. So basically, most of the questions, Sankata, they will ask you a question based on the view or from the point of view from one stakeholder. Then this is the order of distribution. So if, let's say in the case of liquidation, you've sold the asset and you want to distribute the money, right? You don't just distribute it to everyone. No, we have some order of distribution. So you first distribute it to the debts that are secured by a fixed charge. This must be paid out of the proceedings, out of the proceeds of sale of the particular asset. Then the cost of liquidation in other specified by law. So you have to also, if the cost of liquidation is there, then you have to also cater for that one. The preferential payables, example, payee deductions, net, VAT, excise duty, and the likes. Then you have to then move on to payables secured by a floating charge. Then unsecured payables, then preference shareholders, the ordinary shareholders. We know they are the lender of last resort. That's why they are last year. So I think this is it. This is something brief we have to know about this. Let's just take an example and then solve. So this is an example here. So if you have not liked this video, kindly like and then also subscribe to the channel for more updates. So let me read the question. So the question says, move ahead PLC in financial difficulties. A meeting of stakeholders is to be held to consider the company's affairs. The company has sent the following statement of the financial position to the stakeholders on 1st January 2025. Now, this is the statement of financial position. We have plans, we have inventory, we have contract work in progress, we have receivables, then that is the asset side, and we have the retained liability, we have stated capital, we have retained earnings, we have loan, we have taxation due, we have sundry payables, and then we also have bank overdraft. Normally, when it comes to restructuring, what we normally look out for is the assets, the asset that we are having, and the stated capital, and then the other liabilities. But retained earnings is actually not looked into like that. We will actually clear this off because retained earnings is there, but a new maybe right. If in case it also has negative too, we have to also clear it out because a new maybe so now the bank is aware that Move Ahead PLC has been operating profitably, but the financial difficulties has been precipitated by the insolvency of a major customer. So meaning that they were depending on one customer and then the customer has maybe gone into bankrupt or so. From discussions with the company's director, the bank expects that the contract work in progress included in the statement of financial position at 50,000 will prove worthless. So what it means is that this contract work in progress will prove worthless. And that receivables of and that 41,000 of the receivables will prove to be bad, so bad debt. Unfortunately, the bank overdraft was secured on the contract. So the bank is now in the position of an unsecured lender. So initially they secured the contract work in progress against the bank overdraft, but since it is worthless now, so the bank is now an unsecured lender. The only preferential payables are for taxation and 9,000 of the sundry payables. So secured debt here so far is 9,000 of this one, 69,000, and also the taxation here. The remaining liabilities are unsecured. So apart from these two, they are telling us that the remaining liabilities are unsecured. The bank learns that the following proposals are to be considered at the stakeholder meeting. So here, they are telling us that immediate liquidation of the company. In this circumstance, inventories would realize only 80,000. So inventory that is 134,000 will now be only 80,000. And the sale of the equipment would be negligible because of the specialized nature of the entity. So meaning that we cannot sell this equipment because it will be worthless. The receivables would be realized in full apart from the bad debt previously mentioned. So receivables will be in full, but they have to take the bad debts out. Then 2 is saying that reconstruction. So here is liquidation. So most often, if you're even giving the question and then liquidation is last, I would just advise you to do that one first. After doing it, you see that liquidation is so easy. So a reconstruction in which business associates of the director would subscribe to 40,000 in cash for new shares in the company. From this cash, the preferential payables would be satisfied. So meaning that when they subscribe to the when they bring 40,000 cash, you are going to need to pay the preferential payables, which is the 9,000 and the taxation. The condition, the conditions are the non-preferential payables, including Vero PLC and the bank overdrafts, agree to a reduction in their claims to 90%. So they are going to reduce the amount by 90%. Sorry, they are going to reduce their amount by 10% because now it will be reduced up to 90%. So it will be left with 90% of their values in our account of the amount presently due, and that payment is postponed for 1 year and the interest during the year is waived. A reconstruction in which Vero PLC would convert its loan, so that we are done with the second one. The third one is saying that a reconstruction in which Vero PLC would convert its loan into 30,000 shares issued at 1 cedi each and would subscribe a further 40,000 cash for shares of 1 cedi each. In the company, from this cash, the preferential payables would be satisfied. The conditions are that the remaining non-preferential creditors payables agree to a reduction in their claims to 80% of the amount presently due, and the payment is postponed for 3 months, and that interest during the 3 months is waived. So meaning that the amounts that they will be having in their account will not attract interest for 3 months. So the remaining months will be what? Oh, the remaining months will attract an interest. So okay, an interest of 25%. So we'll get it. So Raw PLC offers a guarantee to lend Move Ahead PLC a further 50,000 to meet payment at the end of the 3 months of this, if this proves necessary. The bank is confident that Vero PLC has the funds available. So the existing shareholders of Move Ahead PLC are prepared to cooperate in the issue of shares under either proposal 2 or 3. Under those proposals, bad debts and valueless contracts would be written off and preferential payables would be paid immediately. The bank overdrafts will be frozen at the appropriately adjusted level, and a new bank account opened for subsequent transactions. Assume that the bank charges 25% per annum on overdraft and that the 60,000 shown in the statement of financial position includes interest to pay. Assume for convenience that an adopted proposal would be implemented immediately on 1st January 2025. Ignore liquidation and reconstruction expense. So they didn't bring in any liquidation or reconstruction expense, so they said we should ignore it. If in case they brought it to them, they are telling us to ignore it, we ignore it. Use the figures given throughout. Do not add any extra margin in any of your calculations. So required a calculation of the amount the bank would receive. Read it well. The bank would receive under the first proposal if the information given proves accurate. And then B, statement of financial position for Move Ahead PLC under proposal 2. By making the appropriate provisions on the assumption that the company will continue to trade. And then C, statement of financial position for Move Ahead PLC at 1st January under the proposal 3, after making appropriate provisions on the assumption that the company will continue to trade. And then D, consider the relative merit of 3 proposals that the bank, from the bank viewpoint. So here they are telling us to try and then tell which of the proposals will give the bank the highest kind of money. So let's begin. Right. So So we first start with proposal one, which is saying that immediate liquidation of the company in this circumstance. So we are first going to liquidate the company. So we'll move ahead here also. Right. So proposal one. So we are going to calculate the amount receivable by the bank on liquidation. So calculating receivable. So now on liquidation, what it means is that we are going to sell the assets. So let's write sales proceed. Your sales proceed. So they told us that immediate liquidation in this circumstance, inventory would realize only 80,000. So inventory 80,000. And then they were like, uh, the sale of the equipment would be neglected, so we can't sell the equipment. Receivable would be realized in full apart from the debt. So receivables will be receivables is going to be realized in full, except that they were 41,000 of it, which will be bad. The receivables 135,000 minus 41,000. And we are going to get right. So I think this is going to be our this is the things that you are only going to sell under liquidation. So let's add all. When we add, we are going to get 174,000. Right. Now we are going to distribute this distribution. So we start with the secured debtors. So the secured debtors here or preferential payables here is the taxation and then the 9,000 of the sundry payables. So we have taxation, which is 15,000. If in case there's reconstruction expenses or liquidation expenses too, we have to bring it here. And since some is not in here, then leave it like that. Then we have sundry payables, 9,000. In all, it's going to be 24,000. Now, when we subtract, we'll be left with 15,000, 150,000. All right, so this is what is left for us to distribute among the unsecured debtors, right? So the unsecured debtors is going to be so available for unsecured debtors. Hey, unsecured payables, sorry, or creditors, sorry. Payables. All right. So now you distribute among the unsecured. So distribution among payables. Oh, sorry. Shouldn't just be payable, unsecured payable. So now the unsecured one, we have bank overdrafts, which is 60,000. We have sundry payables, which we've paid 160 out of it already. We've paid 9,000 out of it already, so it will be left with 160,000. Then we also have loan from Vero, 30,000. Right. So now this is so far our unsecured debtors. So we add all of them and then we get 250,000. So looking at it, right, we can clearly see that our money available to be distributed among the unsecured payables is lesser than it. So we cannot pay all. We have to apportion and then distribute it, right? So what we are going to do now is we are going to take the 150,000 all over the 250,000. Then we get a payout ratio. So we are going to get 0.6, right? So meaning that we are going to, out of all of the payables that are available, we'll be able to secure only, we'll be only able to pay 60%, 60%, 60% of it, right? So the question was that how much will the bank receive, right? So, uh, so calculate a calculation of the amount the bank would receive under the first proposal. So calculating the bank will receive. So the bank is going to receive, the bank is going to receive, is going to receive 0.6 times its money. How much is it? 60,000, which is equal to, how much is it? 36,000. So under proposal one, the bank is going to receive 33,000 Ghana cedi. Right. So let's move to proposal two. Now, proposal two is saying that statement of financial position for Move Ahead PLC under proposal two, right? So now let's reread proposal two again. Proposal two is saying that a reconstruction in which business associates of the directors would subscribe to 40,000 in cash for new shares in the company. From this, from this cash, the preferential payables would be satisfied. The conditions are that the non-preferential payables, including Vero, PLC, and the bank overdraft, agreed to a reduction in their claims to 90% of the amount presently due, and that payment is postponed for 1 year, and interest during the year is waived. So 1 year without no interest. So now let's go. So you see that the liquidation is so easy. Liquidation, you just sell and then you distribute. So you sell, then you distribute. That's all when it comes to liquidation, right? So let's move to B, proposal 2. Under proposal 2, we have to restructure, right? So we have to make sure, say, we are going to reorganize everything again, right? And then we will withdraw, because you cannot draw the financial position without restructuring. So we have to do everything before we restructure. So what I advise you to do is to what? Draw an account, draw an account for all the distance. You can either use the journal or use T account. But I mean, I prefer the T account because that's what I understand well. But for the journals, I don't really get it well, so I can't really talk about that. So we open an account for plants and equipment. We open an account for inventories, contract work in progress, receivables, stated capital, retained earnings, loan from Vero, taxation due, payables, sundry, overdraft, and the likes. But when we read the question, where we see that some of the items here wouldn't really be affected, then we leave it like that and keep their balances. For example, since they continue to operate, plants and equipment will still be in there, and then inventories, for example, will also still be the same. Uh, Contract work in progress will be cancelled out. Receivables will reduce, so we have to create an account for it. So now we create an account for contract work in progress. Then we create an account for receivables because it will be affected. Then stated capital will also be affected. So we create, the reason why it will be affected because is because the proposal 2, the mention of it, that directors will subscribe to new shares, right? So cash will also be affected because they say cash will come in. So cash will come. Then um retained earnings will be affected because you have to cancel it out. So retained earnings, then loan from Vero will also be affected. Then uh taxation will also be affected. Then uh, sundry payables will also be affected. If you have not liked this video, kindly like it for me, okay? Kindly do that. Thank you for liking. And then bank overdraft will also be affected. This malaria is really tormenting me. Can't even breathe well. Then we will, in order for us to do the restructuring, we need a capital reduction account. So we create our agboro capital reduction. On we create transactions, then you know, be no capital reduction. So I think with this we can go now. So let's start with contract work in progress. The contract work in progress have a balance of what? 50,000. So Bob brought down 50,000, right? They said it will be proven worthless, so it wouldn't be worth it. So we have to take it out of our account. So we will do that with capital reduction. Capital reduction. And then 50,000. Then this one will be cancelled out. So we come, remember here is at the credit side, so it will come to the debit side of the capital reduction account. So capital reduction, go there. Then work in progress, 50,000. All right. So retain earnings too. I just want to treat someone and see that retain earnings too will be proving worthless. Retain earnings have credit balance here. So balance go down. It's 21,000. Remember, retain earnings is at the credit side of the balance sheet. So we have to also bring it to the credit side here. Now it will be proving worthless too. So capital reduction will cater for that. And then retain to 1,000. We cancel out because it has balance. Right. So we come here. Remember, it was what? At the debit side here. So it will come to the credit side. Retain earnings. Retain to 1,000. Then bank overdraft is having a balance brought down. $50,000. Now, um, the according to the listing, they are saying that both the loan and then the bank order will be reduced to 90%. So it means that some 10% will be given out to us for free. So capital reduction will cater for that. Capital reduction is 10% of this is 6,000. Then we will be having balance carried down to be 54,000, which is the 90% of it. So this account will be closed. Right. So this was recorded at the debit side, the capital reduction. So we'll go to the credit side of the capital reduction and then do that. So credit side, we have bank overdraft. Bank overdraft, 6,000. Then sundry payables. Sundry payables is also saying that because cash will come. Okay, now let me go and then record the cash one. So what they are saying is that the reconstruction with business of the director will subscribe to 4,000 cash. So they'll bring up new capital. So it will come as cash. I'm coming. Let me bring the balance. Balance go down. Uh, it's 60,000. Then they will be adding more distance. So cash will be 40,000. Right. Now we are going to use this cash. So this cash will be debited here. So capital, stated capital, 40,000. Right. Now, stated capital is 40,000. And they are going to use this to pay the taxation and then the sundry payables, right? So they are going to use it to pay to subscribe, and this preferential payables should be paid. So 9,000. So we will give out to taxation 15,000. And then we also give out to sundry payables 9,000, because that's what is what preferential in there. So let's go down there. Now, taxation has a balance go down of 15,000. Now it will receive cash of 15,000. It will be cancelled out. And then sundry payables, has uh, a balance go down of 169,000. Then to receive cash of 160. Sorry. To receive cash of 9,000. Right. So and then they have also agreed to reduce, so including Vero PLC and the bank. They have also agreed to reduce their destiny by 10%. So capital reduction will be 10% of 1,690 minus 9. So it will be left with 16,000, 160,000. And find that 10% of it, we are going to get 16,000. Then our balance carry down. So this account, because they told us that it will be left with 90% of it, we can close it at any time. So 169. So the balance carry down will be 144. Right. So now we move on to capital reduction. We're going to record it in there. So it was at the debit side, right? So it will be at the credit side of this, which was sundry payables. payables, and then it is 16,000. So let me see. Recorded retained earnings, bank overdraft. Okay, so let's move to Vero. Vero also have a balance of 30,000. So balance go down 30,000. So now it will also reduce its this thing by 10 it will reduce 10% of it. So capital reduction will come here. 10% of this will be 3,000. Now when we close this account, and then balance carry down will be this one will be 27,000. Yeah. So now let's go to uh, now let's also look at the receivables where in the receivables account. So receivables is having a balance drawdown of this one. If you don't know double entry, to the check 135,000, and now it will be reduced, right? So capital reduction will come here because the sales sum will be bad, 41,000. That's what the question said. So let's close this account. 135,000. 135,000. Balance carried down. Balance carried down is going to be 94,000. Balance go down 94,000. All right, so let's close the rest of the accounts too. But the stated capital account, they will leave it last because you have to close the capital reduction account before we close the stated capital account. So stated capital account, we leave it. And then now cash, let's close cash. Cash, 40,000. Now, balance carry down is going to be 16,000. Balance go down 16,000. Then Vero, we closed the account already. Payables, we closed the account. bank overdraft to close the account. Then now let's close the capital now. So receivables, then the receivables will be debited because it was credited. The receivables will be debited with the 41,000 because of the capital reduction something. So now we first close the capital reduction account first before we close the other one. So I think I'm left with something. All right, I didn't treat Vero. So Vero will have a capital reduction. So it's at the debit side, so it will come to the credit side of the capital reduction. So Vero, 3,000. So let's close this account. It's going to be 91,000. Now the difference is going to be stated capital. That's why I said that you need to close this one first. So the difference is going to be 45,000, right? So we debit, this is credited in the capital reduction. So we debit it in state capital accounts before we close it. So stated capital, capital reduction, 45,000. To close the account, it's going to be 100,000. Balance carried down, balance open. So this is what is going to appear. So now, since we are done reconciling, now let's draw our balance sheet. Statement of financial position. Position. So, and I like to divide into when it comes to this. So equity and liability will be here. So equity will be here. Then you can reverse the video and then go back and then go and screenshot those entries. Then current assets to be here. So non-current assets. We have PP. We didn't do anything to PP, so we bring it here. So P 36. So when the business continues to operate, then we are going to keep that same value. Now, inventory. So we are down. So let's count current assets. We have inventory 134,000. Then we have receivables. Which the balance that was left in there was 94,000. So we come and then put that 94,000. So those that we adjusted, we are going to bring the adjusted figures here. But those we didn't touch, we are going to just put that same figures in here. So 94,000. Now we bring in our cash. cash we were left with 16,000. Right. And this is all of our assets. When we add everything, we are going to get 280,000. Then let's come to equity and liability. So equity, we start with our stated capital. Our stated capital is 55,000. That was what was left after adjusting, right? So it will be advisable for you to add workings on, let's say, this capital reduction workings one, workings two, and those kind of workings, so that you just be putting them behind the listing. The capital is this. We have liabilities. So sundry debtors, sundry payables, sorry. Now that one was left with 144, 144,000. They bring the same thing here. And then we have loan from Vero. Loan from Vero was left with 27,000. Then bank overdraft was left with 54,000. Right. So now, when we also add here, add the equity and liability, we're going to get 280,000. So you see, it's like it's bulky, and I say it's long, but you'll be able to do it easily. So this is it under the second proposal. Now let's go to the third proposal. It says that the C is saying that statement of financial position on the third proposal. So the reconstruction in which Vero PLC would convert its loan into 30,000 shares issued at 1 Ghana cedi and will subscribe to a further 40,000 cash for shares. In that, in the company, for this cash, the preferential payables will be satisfied. The conditions are that the remaining non-preferential creditors payables agree to reduce their claims to 80%. So here, it's not 90%, further down to 80%. And the payment is postponed for 3 months, and interest during the 3 months is waived. So any interest during the 3 months is waived. Vero PLC offers a guarantee to lend Move Ahead PLC a further 50,000 to meet payment at the end of 3 months if this proves necessary. The bank is confident Vero PLC has the funds available. So now let's go to proposal 3. So C, proposal 3. So we have to also draw all the this thing again. We have to still do the uh entries again, right? You have to readjust everything again. So let's start cash, because cash will come in. So now they said that you let me draw all the this thing. Cash will come, stated capital will come. Then receivables receivables will also come. Then not again, inventory will not be touched, so we don't need to create anything for it. Then loan from Vero. Then bank overdraft. Then once again, contract work in progress. Then retained earnings. Um, then sundry payables on the bank taxation first. Then sundry payables. Then borrow capital reduction. All right, so let's put their balances there for them. And then let's see. So cash does not have any balance here. But later on we receive cash. So stated capital 60,000. Then receivables 135,000. Then which one is here? Loan from Vero. Vero is 30,000. So blah blah blah. Then bank overdraft is 60,000. Then work in progress is 50,000. Then retained earnings is 21,000. Then taxation is 15,000. Then sundry payables is 169,000. Yes, so I think we can continue from here. So sundry payables, for sundry payables, any transaction that was in there was that um let's go and then deal with cash first. Okay, wait. So Vera is going to convert his loan into, so it will turn into stated capital. It will be sent to stated capital, right? Which will be 30,000. So this will cancel out now because that's what they said. They said that Vero PLC will convert his loan into shares. So we convert it into shares, we send it to the stated capital. So those are the debit side of the other one. So 0 is for 30,000. Then he will continue to bring another cash. So cash will come 40,000. Right. So now let's record this in the cash. So cash will receive stated capital 40,000. Now, as soon as cash receive this one, he will pay taxation 15,000, and then we'll pay what again, guys? And then we'll pay sundry payables 9,000. So this is the only cash transactions I think we are going to make here. So we can close the cash account. It's going to be 40,000. Balance 40,000. So it's going to be 16,000. Balance go down 16,000. Right, then we come to say capital. Then we will talk about it last. So receivables. Receivables is going to reduce, right? Because we said some is going to be bad. So the capital reduction of 41,000. Then let's close this account. 135,000. The balance carried down is going to be balance go down. It's going to be now the loan has been dealt with overdraft. Overdraft people too are saying that they are going to reduce their destiny to 80%, right? So we have 20% free destiny. So capital reduction will be 20% of destiny, right? This is going to give us 12,000. 20% of 6,000 is going to give us 12,000. Then our balance carried down is going to be the 80% of it, which is going to be 48,000. 60,000. 60,000. Balance got down 48,000. All right. So work in progress will be cancelled out because it will be proved worthless. For capital reduction, 50,000. Cancel it out. So now let me just go and then record the capital reduction transactions. Here is at the debit side, bank overdraft. So it will come to the credit side of capital reduction account. The bank overdraft 12,000. Then receivables 41. thousand, 41,000, work in progress, 50,000, right? Now, now we have sundry payables here. We are going to pay them cash of 9,000, which we paid already or dealt with up there. And they are promising to reduce their this thing by to 80%. So it will be left with 160,000. So 20% of it will come in capital reduction. It's going to be 32,000. So it's going to be 169,000 minus the 9,000. It will be left with 160,000. So when you find 10% of it, we get 32,000. Now, our balance carry down is going to be 128, because that will be the 80% of it. So 169,000, 169,000. Please like the video for me, okay? Now taxation to be paid with cash. So cash 15,000 to cancel out. Now retain earnings to capital reduction for that 21,000 to cancel out. So it's at the debit side. How many recorded at the credit side of the capital reduction? $21,000. Now, what again? What again? What again? I think we've dealt with almost everything. Dealt with almost everything. So just need to bring the sundry payables, payables here. There's the 32,000. Now, I think we cool. And let's close this account. First, always close this account first before you go and close the stated capital account. So you have 91,000 again. Now, different will be sent to your stated capital. Now, stated capital, what will be sent there is 26,000, right? So, if we close all the accounts, closed, closed, closed. Okay, so now we'll bring it here. Capital reduction, that will mean the reduction 26,000. So when we to the total. So 130,000. 130,000. And balance carried down is going to be 104,000. Balance go down 104,000. Now, after we are done with this, then we are going to what create our statement of financial position again. So we just basically dealt with whatever was in here, right? So we dealt with whatever was in here, where they subscribed for a further 40,000 cash, and the loan was converted into shares, and then the reduction up to 80% of their listing, and then so that's it up to uh, up to yeah now. So let's draw a statement of financial position. So assets here. Let me start with non-current assets. Because they will continue to operate. Because they will continue to operate, then what is this? So we have PP. Because we didn't touch it, we leave the same figure here. This is 6,000. You have current assets where we are going to have inventories, 134,000. Because we didn't touch it. Then receivables, was reduced to 94,000 according to our balance. Then cash, we had cash, just left with 16,000, right? I think that's all for now. Close this account. Going to be 280,000. And come to equity and liabilities too. Equity, equity and liability. Now we start with our stated capital. Just left with 144,000. And then our liabilities, we had sundry payables. Just left with 144. One, 4,000. And then loan from Bureau, Okay, so under the second reconstruction, the loan was converted into shares, so no loan from borrow. No loan was from borrow, was converted. And then the payables was 128. Right, so sundry payables was left with 128,000. Then uh bank overdraft. That was what was kept. So bank overdraft, because the loan was converted into shares. So bank overdraft was 48,000. So here is it. The bank overdraft was left with 48,000. Now when we add all of them, we're going to get 286,000. Now we are done with C. This is our statement of financial position under proposal 2. Is it under proposal 2? Now, please consider the relative merits of the three proposals from the bank's view. So we are just going to consider which of the proposals is going to suit the bank. So D, under proposal 1, remember the payout ratio was 0.6. And then the bank was being owed of 60,000. We were owing them by 60,000 now, because when we multiply by the payout ratio, we are going to get 36,000. So under proposal 1, the bank is going to get what? 36,000. Now under proposal 2, the bank will get 54,000. The bank will get 54,000. The reason is because when we check on our balance sheet in proposal 2, the bank overdraft is what? 54,000. Right? So that's why they are going to get that. So under proposal 3, they are saying that they are going to charge interest. So under proposal 3, they are going to charge interest, right? And what we have in their account is 48,000. Now, see the bank overdraft is 48,000. And they say they are going to charge interest, but the first 3 months will be what? Interest free, right? We using 25%, and the first 3 months will be interest free. So what we are going to do is this. 48,000 is there already. Now we look for the interest rate of 48,000 in 3 months on 48,000 in 3 months. So 48,000 times 0.25 because of 25% times 9/12. This is because first 3 months is interest free. So to be left with 9 months that you are going to pay interest. And with this one, we are going to get 9,000. So that 9,000 we added, so 48,000 plus 9,000 is going to give us 57,000. So you write that looking at all these three proposals, the proposal that will really benefit the bank is proposal 3 because it has the highest money allocated to them. Then you are done. So if you have not liked this video, kindly like it. And I think this is it for reorganization and reconstruction, right? So for consolidated, I will do a video on the associate very soon when I become fully fit. And ratio, so I'll do something about it when I become fully fit. So pray for me. All right, so this is why I end today's session. See you some other time. Bye.